doesn't appreciate an independent central bank, etc., etc. And we all know that there are problems with that. But then where are the opportunities with his policy in the US and what he's doing and how he's reshaping the global world order? And so I'll touch on that finally as well. Okay, so first up, the Trump effect, right? So what are we actually dealing with? So let me just drag this out the way. Trump effect, what are we dealing with? This is an interesting point to start with because we actually have to understand the landscape of investing today, because it's very different to, I'd say, the post GFC period where we had a lot of political, maybe there was partisanship, but it was all very civil. And I think Trump in 2016 and his election obviously changed that. But you had Obama for 2 terms, and Mitt Romney lost in 2012. Everything was relatively stable, and the whole concept of global trade and globalization was really appreciated, and there was never questioned. So now this is coming into repute, I would say, and there are big questions being asked about the current paradigm of growth. And I think for most of us, we were kind of shook by Liberation Day, right? We kind of went into it knowing that there was going to be something happening. This is a scene from one of my favorite TV shows, Succession, but this is Tom Wamsgam just freaking out. And I think most people probably had that same reaction on April 2nd, right? When markets suddenly just crashed, and you kind of saw the rates that he was positing on countries such as China and India and Thailand and a lot of Asian countries actually, including Singapore. Singapore got off light, but basically he was changing how global trade was being done and how global trade was going to run. And so this scared a lot of people. We obviously saw portfolios got hit. A lot of people sold out, probably felt like it was a mistake, and we've now seen a rebound in markets. So it's been a really quick ride down, but also a relatively quick ride up, which isn't maybe normal in most market scenarios, right? Even we have usually a big drawdown. It usually takes maybe 6 months to 12 months, but historically that's been the case, but maybe not so much in recent times, because we saw COVID, that drawdown was pretty quick, and then we saw this drawdown of close to 20%, also relatively fast before it got reversed. So I think this has shaken people to the core and realized he's serious about changing things up. And what's that resulted in, right? What's happened post Liberation Day? Well, we've seen the greenback, or the US dollar rather, has just had its worst first half or 6 months of a year in over 50 years, basically. And since like 1972, 73, it's had its worst first half, and it lost around 10%, just over 10%. So the DXY index was down 10% against a basket of global currencies. And so that kind of tells you maybe what you need to know about the reaction to Liberation Day. And I think a good point that's always been made in markets by commentators is the fact that when we had COVID, what strengthened, right? The US dollar. The US dollar strengthened, yields fell because people went into treasuries. And this was more of a flight of safety to USD assets during COVID, because the uncertainty typically, it's a safe haven, right? Treasuries, dollar, it's a safe haven. Stocks fell, but that's normal. What happened post Liberation Day was yields spiked, markets tanked, and then the dollar tanked as well, which is really unusual to have all three happen at the same time. And that speaks to the fact that the US, or how it was viewed perhaps by global investors, is that was more emerging market behavior. That's something you would typically expect to happen in maybe Turkey, Indonesia, Egypt. It wasn't really something you would expect to happen in the world's largest economy and the world's largest treasury market, right? Is for all three things to fall. And that's exactly what happened. So bonds fell, stocks fell, and dollar fell all at the same time post-Liberation Day. And that kind of told you a lot about how global investors were viewing the US. And then again, it's no coincidence, right, that gold's had its best first half since 1980. So over 40 years, it's had its best first half, delivered close to 30% returns. And we've kind of seen a leg up in recent weeks for gold again, given all the talk about the Fed, which I'll touch on again later. But there's no coincidence that the dollar's fallen, gold's risen strongly into the first half of this year, and it's continued to do well in August and September as well. So even though it was range bound from maybe sort of May to August, it's had now another leg up since last month, and it's continued to do well. And we can kind of see why that's the case, right? US interest payments are out of control. Net interest spending is now actually higher than defense spending. You can kind of see the top line there. Ignore the bottom in terms of the Fed surplus or deficit. But this is a great chart that just indicates how much the US is spending just on interest, right? Given their $38 trillion, $39 trillion debt pile, which continues to rise. So last year, or I think late last year, was the first year basically where defense spending in the US is now actually below what the US is spending on its interest payments. And so you kind of see this really push-pull between the fact that the government really needs to get interest payments down, doesn't like high rates. You've kind of seen that through Trump and what he's been talking about. And so really we have to really understand the fiscal picture of the US, which is not in dire straits right now. I mean, it's not good, but it's not in panic mode yet. But it's something that will continue to worry investors for at least the next 3 to 5 years. And as I'll show you in a couple of slides, that's something that professional investors are particularly worried about. The US deficit, right? We know how big the deficit is. There's always going to be times where the deficit has a front seat in terms of headlines, what people are saying about it, whether it's worrying markets. We saw the debts or the credit rating downgrade in 2012, 13, whether that was, I think, Moody's or S&P, that really freaked markets out, right? And then the debt ceiling debacle, which also freaked out markets. But it usually comes in ebbs and waves. But right now, it's not in the market's sights, but it's something that I think professional investors are starting to feel is going to become a major influence in the next sort of in the medium term, right? We see on the left-hand side, the 1-year horizon. What do people think about the fiscal deficit, right? Is it just noise? Most people think it's going to be an influence, but not massive. Whereas if you look on a 5-year horizon, we can kind of see professional insti investors really do believe that the deficit is going to shape the market and where we're going for the US market especially. And why would anyone want to own treasuries in this environment, right? We've kind of seen, even though Fed funds rate has actually come down, the 10-year yield is still high, and it really doesn't matter on a range of assets, whether you're pricing mortgages or you're looking at the risk-free rate. It's really going to be treasuries rather than Fed funds rate, right? And treasuries have had an absolutely horrific 5-year and 10-year period on a nominal basis. If you're looking at the 10-year on the left-hand side, on the right, and the right-hand side, 5-year rolling nominal returns, these are actually the worst nominal returns for US treasuries on record. So going back to sort of 1795, 1800. It's not as bad on a real return basis. Real return basis was worse sort of in the 80s when inflation was, 13%, and also post World War I when inflation kind of spiked. But on a nominal basis, we've just had a really terrible period of 5 and 10-year rolling returns for US treasuries, and people don't want to touch it, right? Why would you want to? So it's kind of people are questioning, what do we put into my portfolio for that defensive ballast if we can't trust treasuries? And that's something that's worried a lot of investors given the size of the US treasury market. And we've kind of seen this in the dispersion, I'd say, between 2 and 30-year US treasury yields, right? It's telling us a story. People are really coalescing around the short end of the curve, right? They don't want to take any duration risk by going further out. And you've kind of seen that with the popularity of short duration bond funds. I mean, even in Singapore, which has nothing, actually, this is not to do with US treasury yields, but they just launched, Lion Global's just launched, I think, a short duration bond fund in an ETF form, which is going to be launched at the end of September. But it kind of tells you the popularity of short duration at this point, right? Everyone's going, at the short end of the curve. They don't want to be taking any duration risk because they don't know what's going to happen in terms of fiscal deficits, in terms of, getting burnt like they did in 2022 in case the Fed's cuts but then has to raise again. So they don't want that stop-start potential scenario where they get burnt on the long end of the curve. So we've seen a lot of people really just go into the short end, into short duration, and 30-year and 10-year, people don't want to take that risk. And so it's kind of telling us a story about where people see the US fiscally, at least in the next sort of 5, 10, 15 years. And this is all while Trump is looking to spend more, right? We kind of saw what he did in the One Big Beautiful Bill Act, had lots of pork barrel spending in there. He's giving lots of goodies out. And it's strange because amongst this whole rejigging of the global world order from Trump, he's also not a traditional Republican, because traditionally Republicans are fiscally conservative, but he's actually more democratic. He wants to spend. He's happy to spend. He's happy to spend, but also cut taxes. So it's almost a double whammy for the fiscal deficit in the US, where there's literally no control over what he's spending. He's just putting in goodies for stimulus for whoever, and then also cutting taxes where he can possibly cut taxes as well. And that's really just going to balloon the deficit beyond what conservative estimates already are. So this is something that we need to watch and be aware of as investors, just heading into the next sort of 12 to 18 months. Okay, so covering that bit now is done, and I think for us we'll be moving on to how is the world changing, right? And how is it changing under Trump's purview and in his vision of the world order? Because we all know the US president, whether we like it or not, is the most powerful political position in the world. And so how is he changing it, and what is happening in the world for him to sort of take on this initiative to really change things up? Well, first off, we have a balkanization of alliances, right? And so when I talk about balkanization of alliances, I'm talking about traditional allies of the US. They've really been frozen out, or they've been told to come to the table and make a deal. And that deal typically means America first, right? It means spending more. America's not going to be your security umbrella. We're not going to be footing the bill for everything. And so this is a good example from earlier this year with NATO now really committing to 5% of GDP for defense spending. Whereas previously, a lot of European countries weren't even meeting their sort of 2.5% to 3% of GDP defense spending commitment. And now NATO is saying that they are really going to ramp up spending on defense. And we've kind of seen that play out with the amount of defense companies that have just skyrocketed in Europe so far in 2025 or post Trump's election. And so these are unintended consequences perhaps, but there are countries out there who are traditionally fiscally conservative. They're actually going to start spending a lot more money. Germany is an example. Like Spain is an example. Italy is an example. They're starting to spend more on defense. Spain probably could spend more. France is spending more. So these are all European countries that have maybe traditionally been a bit more reserved in their willingness to spend on defense. But with Trump in the White House now, they realize they've got to step up and they have to spend, given they can't trust that the US is going to be there for them. So this is an example of how Trump's really trying to think of America first, doesn't want to be giving out money, doesn't want to be giving out goodies to traditional alliances and footing the bill for defense when he thinks that they should also be fronting the bill. Sorry. And who remembers this, right? In the White House earlier this year with President Zelensky of Ukraine and him lecturing President Zelensky, and then Vice President J.D. Vance basically just scolding him in front of the global press. And that was an embarrassing moment. So I think the concept of what he was doing in terms of trying to get a peace deal over the line was unconventional, right? And so this kind of behavior is alienating a lot of traditional allies to question whether they can actually trust the American government, the American political framework, and the leadership if this kind of behavior is going on. And so it may be the way that he's trying to change the behavior is the wrong way of doing it. I think most people would agree. But I think what a lot of commentators have noticed is that there's not that much disagreement in terms of the need for Europeans to spend more on their defense, and maybe perhaps even a lot of Asian countries to spend more on their defense, which again is happening, right? We're seeing that in South Korea, we're seeing that in India, we're seeing that also in Singapore with some companies like ST engineering absolutely skyrocketing because they're going to be spending more on defense and they're getting more contracts. So global defense spending is rising, and that's really helping a lot of niche companies and niche sectors really perform. And we're at the start of a multi-year shift, right? I really think that military spending over the past sort of 2 decades has always been dominated by the US. China's not really grown that much, but it's starting to come into its own. Russia's really nothing significant. But the rest of the world has been sort of growing, and I think it will continue to grow. And the EU and Britain really punch below its weight in terms of what it should be spending on its defense versus the size of their economies, right? And so I think we're going to see that EU 27 Britain share grow and the rest of the world share grow because people are going to realize that they can't rely on the US, they can't rely on Trump, they can't rely on those traditional alliances that they thought were unconditional. And clearly they're not, right? Nowadays, Trump attaches conditions to support. And so that insecurity perhaps is leading to more security spending, excuse the pun. So it's more about money wins for Trump. Money really trumps everything. And again, a scene from Succession with one of my favorite characters, Logan Roy. But it's one of those situations where the U.S. is really imposing its own vision on the world, and it's not a multilateral agreement. It's really more of a this is the way that we see it, and this is what you'll have to do to abide by it. And I think for a lot of investors, globalization as a whole is not dead. And I've seen this talked about a lot in terms of some commentators actually believe globalization is continuing. It's just going to continue without the US, right? We see China trading more with the global south. We see ASEAN starting to step up and trade a lot more with China. And so there are going to be multilateral and bilateral trade agreements, much more than there are maybe these regional trade agreements, which are probably a paradigm or probably a relic of the 2000s, 2010s when you had NAFTA, and then you had like a lot of regional trade agreements in Asia that maybe took off. The last big one I think was RCEP in 2019, which got agreed with a lot of Pacific countries as well as Asian countries. But that's not really the name of the game now, right? It's going to be bilateral trade agreements, whether that's between India and the US, whether that's between Singapore and the UK. And we've kind of seen that play out with Trump and his team with the Liberation Day tariffs, right? He's gone to each country individually and said, this is what we want, and this is what we are expecting from you when you trade with us. So there is a bilateral relationship. It's not saying, I'm going to a region and saying this is what I want, or I'm going to Asia and saying this is what I want. He's going to each Asian country and saying, these are the terms that we need to agree on, and this is the way it's done. And I think that's going to carry forward to trade relationships, globally, not just in the US. And who does China trade with, right? I mean, we kind of seen this on the left-hand side. It was trading more with the US in 2015, 14%. And that's not really, it's not huge, but it's still a good amount. But it's obviously, they've learned their lesson, right? They've learned from Trump 1.0. They've learned from Trump's first term in office. They don't want to rely too much on Trump. They don't want to rely too much on the US. So the US share has come down as a percentage of overall value of trade, export and imports. And the global south has risen, right? And what do we mean by the global south? The global south includes South and Southeast Asia, so you're talking India, ASEAN, Middle East and Africa, Central Asia and Latin America. And all those countries, there are some sizable countries, whether it's Indonesia, Brazil, India. So trade with these countries and China is growing, right? And so I think that's the key, is that there will be a continuation of this global growth, but maybe the US won't be a part of it, won't be a part of that new model. And so I think it's something we all need to be cognizant of when we invest and how we think about allocating our capital. Okay, so President Trump and the Fed. I'm just going to take a break here. Hold on a minute and just make sure you guys are okay. If you do have any questions, please do put them in the box. And I'm just going to take a bit of a water break. If you do have any questions, do add them in the box. Just a reminder, I hope I'm not flying too quick through things, but just put them in the box there and I will get to them. And let me get back to presenting. Okay, so we're going to touch on Trump and the Fed, right? And so we kind of know what Trump's issues are with the Fed. He doesn't like rates being high. He hates interest rates being too high. It's not a surprise. We've kind of taken a look at the fiscal deficit. It's not good. He's taken umbrage at the fact that the Fed cut just before the election. Didn't like that. Didn't matter because he won in the end. But anything that looks like it's not in his favor, he doesn't like. So anytime that he thinks that rates should be lower, which is most of the time, he's going to be upset. And he's really taken it personally. And he's attacked both, Chairman Jay Powell and also he's attacked other Fed governors, as we'll kind of touch on as well. But I think before I get into the whole Trump and Fed beef, I want to talk about what Jay Powell is really trying to do. And so we kind of seen Fed independence questioned the last time, I would say, maybe in the 70s. And Fed independence is actually enshrined in law via the Federal Reserve Act of 1913, right? And so that allows the Federal Reserve to be independent of political influence, technically. And that's held up for over a century now, give or take. And so the last time where maybe political influence started to creep into the Fed was in the 70s when Nixon came to power, and he appointed Arthur Burns as his Fed chair, right? Got rid of the other guy, or said he should step down. And Burns was the replacement in the early 70s. And we kind of see as soon as 70 hit, inflation kind of crept down to about 3.1% by 72. But then by 74, as the Fed started to cut, it started to spike. So 3.1% CPI in 1972, that shot up to close to 11.1% by 1974 in just 2 years. And so you've kind of seen how the Fed doesn't want to be perceived as that in that sort of era where it's a stop-start policy. So what happened was they cut, then they had to raise, then they thought they could cut, they cut, and then they had to raise again, right? And so inflation really wasn't vanquished until Paul Volcker came to power. We all know that what happened in the 80s where the Fed funds rate was lifted to sort of 18-20% and really inflation was crushed. But this whole scenario played out, as you can kind of see from the 70 to 80, this played out for nearly a decade, right? And so what Jay Powell doesn't want to be remembered or associated as Burns. So I think for him, there's a lot more conservatism in his approach to how prices are being perceived today in terms of inflation. And obviously, you don't want to talk about transitory because that wasn't something that was associated with any good outcomes after the whole 2022 debacle. But what he's basically been insinuating, I'd say, throughout the FOMCs over the past 2 years is that really it's data dependent, but he also doesn't want to be led astray by one or two data points saying inflation's come down, and that means that's a green light to cut aggressively. So I think that's important in framing where we're at with the Fed right now in terms of going into today's actual meeting where the statement, the expectation is a 25 basis point cut, but that's been priced in and we all know that. But in terms of the mentality of Jay Powell and what he's thinking in terms of his legacy, right? Because he doesn't care. He doesn't need to make millions off interest rate moves, and obviously all his assets are like privately managed. It's more about a legacy, right? And I think he's worried about what his legacy is going to be remembered for. But why does Trump actually, quote unquote, hate the Fed? I mean, for me, I think it's more of a power struggle. There's a person in the room, or there's a player in the markets that's more powerful than him, and he doesn't really appreciate that, right? So there's a couple quotes that were as recent as June or July with Trump saying whoever's in there will lower rates, right? If I think someone is going to keep rates where they are, I am not going to put them in. So I think he enjoys the power of saying he's going to be able to appoint whoever he wants once Jay Powell's Fed chair term ends, which is actually in May 2026. So not that far off. But then the second quote is interesting, right? I think it kind of speaks maybe to Trump's insecurities and how he views the Fed and the Fed chair position, because it is powerful. And so what he said is they just show up to the office once a month, flip a coin and everybody talks about you like you're a god. So I think he doesn't appreciate the fact that maybe Jay Powell and the Fed board have so much influence over where markets are going and how asset prices are moving. But I think the Fed had a period in the 2010s where inflation was really benign. No one watched data points. No one really cared what the CPI was because it was always like sub 2%. Inflation never moved. It was all very much sort of maybe Goldilocks, but even inflation maybe had been a bit low. But nowadays, everyone's watching the next data point. Everyone's watching the next CPI print. Everyone's watching that PPI print. Everyone's watching, the next PCE print at the end of the month. They want to understand where it's heading and what that's telling the Fed, right? So I think the Fed's never really had this much attention from investors in, say, 15 years since pre-GFC. So I think this is really where the Fed is maybe upsetting Trump's obsession with hogging the limelight, and that doesn't go down well with the president. So who's likely to replace Powell? At this point in time, it looks like it's going to be Christopher Waller, which I've circled here on the right. Current Fed governor, very dovish. Obviously, Trump is not going to want to put in someone who is hawkish. So Waller is well respected. He's actually come out on record saying he believes in an independent Fed, so that's positive for investors, I would say. But that doesn't mean that that's going to play out. Maybe when if Trump does appoint him. So I think this is something that we need to watch closely. But do remember, Trump actually appointed Powell as well in his first term. So this is not something that this Fed chair is not someone he's inherited actually from a previous president. He actually appointed Chair Powell in his first term. So remember Janet Yellen, she actually stepped down, and she was the pick of Obama. So this is a different scenario, but I think Christopher Waller at this point in time is the lead sort of favorite from the market perspective. Okay, so given all that, where are the opportunities, right? It's not ideal that the Fed's independence is being questioned. I don't think that's necessarily good for markets. Obviously, the market short term is going to like lower rates. They're going to appreciate that. We've seen that with the lower CPI and the pop in markets, given the expectations the Fed's going to cut, et cetera, et cetera. And short term that might be good, but I think longer term there are questions which I'll touch on as well. But where are the opportunities for investors if we're looking, whether it's in the US or outside the US, based on the scenario that we have with Trump, with the politics, with the markets that we're in right now? And for me, a very obvious one is Singapore, right? I think Singapore has really returned on a lot of investors' radars for the fact that, okay, the market here is small, but we've got a couple of drivers that are supporting local equities, right? First off, a strong Singapore dollar. Second off, government and regulatory support for the markets, whether that's in the SME space or the equity market development program, that they've put up, whether that's 5 billion, which is actually not that much, to be honest, but I think it's more sentiment driven, and it's the show of support that's helping people think, okay, this is something that the government is serious about, right? But I would say on the Sing dollar side, if you're thinking about the Straits Times Index, it's up around 14% year to date on a price basis. S&P up maybe 12%, but the Sing dollar is up nearly 7% year to date versus the greenback, right? So it's done very, very well. So on a Sing dollar basis, you're better off in Singapore so far in 2025 by up to sort of 9 percentage points. And I would say that the Singapore dollar has become almost a safe haven currency in a sense, almost like the Swiss franc. I mean, it's quite amazing to know, but in terms of 10-year, 20-year, and 30-year returns, there are only two currencies that have strengthened against the US dollar over all three time frames, right? 10 years, 20 years, 30 years. One of them is the Singapore dollar, and the next is the Swiss franc. So it kind of tells you how investors perceive Singapore as a haven, whether that's on the currency front. We know equity markets have done well, but I think the currency is one of those that's overlooked, right? I mean, the currency has done incredibly well on multiple time frames versus the dollar, and it's only strengthened in this first half given how terrible the dollar's done. But but everyone knows how strong the currency is. And why is that the case? I mean, there are a couple of reasons for that, right? Fiscally responsible. Singapore is the only Asian country. I'm not calling Australia Asian, but Australia Asia Pac. But Singapore's the only Asian country that's got a AAA rating, government credit rating from all three credit rating agencies in the world. And so they're one of 10 countries that have that. And so they're part of a special club. And so with the US dropping out finally with the last downgrade, I think earlier this year, everyone knew it was coming. It's really Europe, Canada, Singapore, and Australia that really have those AAA credit ratings from all the agencies. And so it kind of shows you how Singapore is respected in that sense in terms of its debt. And I think one thing I've really highlighted is there couldn't be more of a contrast between political leaders than maybe PM Lawrence Wong and President Trump, right? On the left, we have PM Wong, who is really the epitome of establishment. He is no more establishment than you can get, right? He's part of the party that has been in power for however many years in Singapore. He's been groomed to take over from PM Lee. He is not anti-establishment at all. He is total establishment. And on the other side, you have Trump, who is unpredictable. Don't know what he's going to do. Maybe he's going to whack 100% tariffs on this country, but then he's going to take down tariffs on that country next day. So there's really no predictability or stability in the Trump arena. Whereas with PM Wong and the current Singapore political system, there is stability. There is what investors like, right? If anything, investors hate uncertainty. We all know that. That's like the cliche, right? Investors hate uncertainty. Markets hate uncertainty. And I think with PM Wong and the PAP and what you have in Singapore is you have certainty. If anything, that is certainty. And so I think markets really appreciate that. And so I think that, for me, is always an interesting contrast between one end, the unpredictability, and the other end, really this stability and this predictability of what you're going to get. And emerging markets liking that, right? They like that. They've been enjoying the ride up so far in 2025. We've seen Brazil's equity market do incredibly well. We've seen China come back with the Hang Seng, roaring ahead. India's lagged, but we know India's structurally a great story, but India's lagged because flows have come out of India and gone into China. Korea's markets hit an all-time high recently. Kospi's hit an all-time high. Defense manufacturers are doing well. Banks, financials are doing well. Chip makers are sort of rebounding as well. So I think there is a lot more optimism than maybe the current picture is painting from what you're seeing in headlines, what you're seeing Trump doing, what you're seeing with the trade war. There's more optimism in markets, and you'd be surprised in terms of the top performers, I'd say, in 2025. And so returns have been solid. We know the weak dollar is bad. That's boosted emerging market dollar returns with local currency returns. This is a good chart from BlackRock Investment Institute, just taking a look at the DXY at the bottom. Tanked so far in 2025. Developed markets done, yeah, okay, but EMs have done even better, right? On a local currency basis, sort of close to 20%. But if you're looking at a dollar basis, because the dollar's done so badly, it's over 20%. And so I think EMs have really started to shine in 2025. And it's kind of making people reassess, maybe they should have more of an EM allocation in their portfolios. Okay, we move down into the US and look at a little bit more at the sector level. Small caps, they've caught up in August. If we think about rate cuts immediately off the bat, who benefits, right? Lower cost of capital. Small caps are going to benefit. And we've kind of seen that play out in August. There was a lot of data coming through, expectations raised, odds on that there was going to be a cut in the September FOMC. And we've kind of seen consumer discretionary. If you can look at the third column, S&P small cap 600 cap sectors has outperformed, right? Done great. Financials has done great. You're talking about small banks, cost of capital coming down. Mid caps done okay. Obviously, large caps probably lagged. But if you're looking at the big beneficiaries right off the bat of a rate cut, it's typically going to be small caps, right? But I think maybe the market's getting a bit ahead of itself. Are they expecting another rate cut before year end, and then that to continue into 2026? If that does, and the rate cutting cycle is pretty quick and it accelerates, then I think that's fair to assume that small caps are going to continue to do well. And we know small caps have underperformed for so long, right? So they had a good month. That doesn't, again, that one data point doesn't mean that they're going to continue to, but it's an interesting maybe switch up in performance. And if we kind of see the Fed be dovish in today's press conference, that might give it some extra juice to the small cap rally. And so about winners in the US in the large cap sector, right? S&P, you're looking at industrials outperforming. They've done really well. Why? Things moving back to the US, people reorganizing supply chains. And so there's a lot of industrials that are actually maybe benefiting from the One Big Beautiful Bill as well, but also a push to kind of rejig supply chains back towards the US, right? And so industrials have done well on both the year to date as well as a 12-month basis. And you can kind of see others like materials, and obviously we have the tech guys who have done great, but that's been an AI-driven story, right? So outside of AI, what else has happened? In industrials have benefited from the AI theme as well, right? They've got the data center operators that are buying specific materials and specific components. So there is a build out. There's a massive AI build out in the US, and we know that's benefiting a lot of traditional tech companies, but it's also benefiting sectors like industrials and materials as well. Okay, so what about the top markets in the first half of 2025 globally? So this is a good one from Bloomberg, looking at the first 6 months. You'd be surprised, all three developed ones in Europe, Austria, Spain, and Italy. Not something you'd expect typically from a top performers market perspective. And emerging again, all European, right? Greece, Czech Republic, and Poland. So Europe's really having a renaissance in terms of how people are viewing Europe. Okay, Europe is typically means stingy. They don't want to spend, or they don't have tech giants. But what are they starting to spend on now? They're starting to spend a bit more on defense, or a lot more on defense. Markets are holding up pretty well. Inflation isn't as bad as feared. So they're thinking, this is a good opportunity for certain investors in certain spaces in Europe, right? I mean, financials in Europe have done absolutely amazing in 2025. And so that's really caught the attention of a lot of investors. And if we take a look at the worst performing markets, US is a large one. I mean, it's still up 6.5%, but it's lagged. Thailand's done poorly. Turkey, Indonesia, and Thailand, we have a weak consumer there, weak consumer sentiment, and a weak baht, so that's not helped sentiment. But India is positive on sort of a 5 to 6% basis, but there are concerns in India with trade, at least with the US. But I think structurally, India has just really been maybe a victim of flows, right? Flows have come out of India in 2024, solid year, and gone back into China. And if we talk about EM allocations, it's always China and India, right? So if China's underperforming, you're underweight China, you're overweight India, India starts to underperform, they just allocate out, right? They just roll over into China. We've seen a lot of insti managers and fund managers and asset managers do that in the first half of 2025. And what does it mean, finally for gold, right? I mean, this might be an interesting topic or point that maybe some people aren't aware of, but the best performing asset in the 21st century is actually gold. I mean, if we exclude Bitcoin. Looking at treasuries, T-bills, S&P 500 equities, gold has given you a 11-fold increase in total return. Okay, so this is the total return. It includes dividends. Obviously, we know gold doesn't pay an income or any asset. It doesn't yield anything, whereas the S&P yields something. But on a total return basis, it's still beating the S&P 500. S&P's up around, sort of is giving you back about 8.6 times your money. Gold over 11 times your money in since 2000 in this 25-year period. So the best performing asset so far in the 21st century since the millennium has actually been gold. And that might shock a lot of people. But we've kind of seen gold its next leg up happen, right? But this whole idea of Trump reorganizing this world order, which has been agreed upon, post World War II, the Bretton Woods system, and now thinking everything's conditional, that's got people worried. And you've seen flows from central banks into gold. You've seen investors go into ETFs, and it's more of a hedge, right? It's an insurance on portfolios. And we've seen gold really start to power ahead again in sort of September. So I think it's an interesting chart to me that tells me that you might think gold definitely does have periods of underperformance, and it does. And this is just a snapshot again. If you look at rolling 20-year periods, obviously the S&P performs or outperforms gold on sort of, I'd say, 2/3 of those times. But it's an interesting chart nonetheless, right? Because gold is really there for investors as a hedge. I don't think you expect gold to shoot up, and you definitely don't expect to allocate 30, 40, 50% of your portfolio to gold. But there's definitely an under allocation, I think, among investors. So people are starting to think, do I want to allocate maybe 3%, 5%, 7% if I don't even have an allocation? And that's driving flows into gold. Okay, so I'm gonna just wrap up, right? Trump, what does it mean? Uncertainty. I think that's basically the word. It's uncertainty. And uncertainty, as we all know, is just terrible for markets. So first off, Trump's reshaping the global world order in his own way, in his own vision. That doesn't necessarily align with pretty much any country. But he's made that clear, right? America first, we're doing things for America, and it's nothing, we don't care about anyone else. And if there is something that we have to offer you, it's going to be strings attached, conditions that you have to meet. Number two, doubts on the Fed independence. I think on the whole, they're going to be a negative. I hope it doesn't get worse than it has. I don't think it's been that bad. He's come out with some tweets and some things on Truth Social. Yeah, he has a view and he's vociferous in it. Hopefully it doesn't get worse than that into meddling with whoever goes in, or firing, trying to fire Lisa Cook, which wasn't allowed by courts. So there's hopefully some restraint there from the courts on what you can do with the Fed. But on the whole, this is a bad thing. I think that the Fed independence has been a great thing for the U.S. markets, and it's something that investors appreciate. And then finally, select winners. We have select winners inside the U.S. and the rest of the world, but the rest of the world has become such a small part of the global market, maybe in relation to the U.S. If you look at the MSCI ACWI, right, you talk about the U.S. All Country World Index. What does the U.S. make up? Around 65%. What's the next country? Like Japan at like 6%. So it's just such a big gulf in terms of the size of the U.S. market. So we can't ignore it, but it's making people reassess how much they want in the U.S. and should they allocate or reallocate outside, whether that's Japan, Europe, Brazil, China, India, whatever it is. There's a reassessment there about how much they should have in the U.S. And so this is something that's going to continue to be a thought, I think, for investors in the medium term. Okay, so thanks for that. Do follow me on my socials. You can find me on Tim Talks Money SG, where I like to talk investing, money, try and break it down for you, and do sign up for my newsletter at timtalksmoney.com. And I will try and get to questions. Let me just stop this. Hold on a minute. Okay. Oh, sorry. Stop my share. Okay. So thanks for staying with me for nearly an hour. Hopefully you found that informative, a bit interesting. I'll try and get to the questions now and answer everything. Please don't hesitate to ask any questions. Put the questions in the box, and I will definitely get to them. Okay, so Chi Wong, I'm gonna go with the first one here, which is, what's your view on U.S. Fed interest rate cuts for today and rate cuts going forward? Okay, so my view is that I think they will cut by 25 basis points today, because I think that's really the market expectation. And I think they'll cut again once before the year end. I don't think that they will wait to act on a weaker labor market. And the labor market, we've seen the adjustments from the BLS, and they are huge, right? And this has been a point of contention, I think, for a lot of investors, is why is the data being readjusted and adjusted downwards so heavily, right? I think we had a 900,000 adjustment recently for earlier, like a June or July jobs report. Something crazy, or sorry, a culmination of last year or year to date, there was a massive 900,000 jobs that were adjusted downwards. And so that's kind of got people questioning the veracity of the data, or how can you be having such massive sort of variations in initial job reports. Because do remember, when they come out with the employment report at the beginning of each month, it's just really an estimation of what's happening, right? They do adjust those numbers the following month, and then they kind of continue to tweak them as time goes on. So in terms of the Fed cut for today, I don't think he's going to be too dovish in terms of doing 50 basis points. I know there are some board governors that do want to maybe cut by 50. I don't think it will happen. I think it will be 25. I think then they will watch to see further on the CPI front as well as the PCE. So the PCE will be out at the end of this month, and that's actually their official gauge for inflation, right? I mean, everyone concentrates on CPI, which is important, but the actual Fed preferred gauge of inflation is PCE, which comes out at the end of the month, and that looks at, personal consumption expenditure. That's more of a, I think more like varied look at inflation, and so I think that's a better gauge for the Fed. And if that's low, that's positive. So we'll kind of see, but I think there will be 2 cuts this year in 2025. Going to 2026, it's interesting because I think by then maybe Jay Powell will kind of be a lame duck in terms of the Fed governor chair, right? It's going to be, people are going to start talking about who's going to be taking over in May. And if Waller's kind of being decided on, I think there could be definitely more of a dovish tilt in 2026. But again, it depends. It's just so data dependent on what's happening with the jobs market. But I think from the comments we saw in the last FOMC, or sorry, from Jackson Hole, is that the Fed is really now starting to shift its attention to the labor market. And if we're going on that concept of they're looking at the labor market, then the natural assumption is they're going to be dovish, or they're going to lean dovish, right? And so I think that's what I would assume will be happening in the next sort of like 3 to 4 months. Okay, I'm gonna remove that, so hopefully answer that question. Okay, so Han, how will Trump's trade policies affect specific industries such as manufacturing, energy, and technology? So what are the potential winners and losers in this economic landscape? Yeah, that's a great question. So I think trade policies are, well, I think okay, so in terms of the actual specific industries like manufacturing, energy, and technology, it's all going to be large cap, right? I think small cap I mentioned as winners maybe in certain niches where there's more ability for them to benefit quickly from rate cuts. But if you're actually talking about what's going to happen on the industry front, or maybe the market cap front, I think large caps, because of their pricing power, because of their size, because of their ability to put pressure on suppliers and supply chains and sort of impose their pricing power on the market, they're going to come out better, right? So when we first saw the Liberation Day tariffs drop, everyone was talking about like, oh, what's going to happen with whether it's Walmart or whatever, and they're looking at Walmart has a lot of sort of imports from China and all this. But in the whole, actually, the guys that are going to do okay in that kind of environment where tariffs are high and things are expensive are going to be the Walmarts, the Costcos, the Amazons, because they're just so humongous. There's so much pricing power and cash there and cash flow that they're able to absorb it, right? And it won't be detrimental, or won't be maybe fatal to margins. Whereas that perhaps isn't the case on the small and mid cap space, right? Especially for companies that rely on a lot of components coming from China, India, anything else where there's massive tariffs. They're not going to be able to absorb it. Whereas I think with the large cap players, they're able to do that, right? The mega cap players, they can do that. When you're talking about specific industries, I mean, manufacturing, energy, technology. Manufacturing is something that the Trump administration is obsessed with. Doesn't really make a lot of sense from a perspective of GDP per head. You saw all the memes about the AI creating those people, fitting components in the iPhones, and everyone's saying like, why do you want to do that, right? Why do you want to bring iPhone manufacturing back to the US, or why do you want to bring the manufacturing of toys to the US, because they're such low value items? So it's like those kinds of things that are difficult to foresee anything happening on the manufacturing side. Energy side right now, what's hot in the US is really nuclear, right? Nuclear is something that both parties are able to get behind. So whether that is Trump talking about, he was at that Bitcoin conference last year pre-election where he's talking about he's going to bring so much electricity and to the US and it's going to be beautiful, et cetera, et cetera. He's actually a supporter of nuclear, and I think his administration wants to promote nuclear. But why, right? Because nuclear nowadays, you've got a lot more small modular reactors, which can potentially be profitable at a shorter time scale. You don't need massive capex to build these plants as much. They're not ugly like wind turbines or solar farms, which he hates. So I think there's that maybe bipartisan support for nuclear. And especially since we've seen Ukraine and Russia, right? That whole war and how that impacted Europe, where they're dependent on Russian gas. That's something that you just don't want to have. So national security, that also extends to energy security. And so I think that's really helped nuclear players. And we see some nuclear players continue to do well. And if that story of AI power demand continues, I could easily see nuclear continuing to power ahead. Technology, we all know semis, right? Semis are doing, I think the picks and shovels players, they're the ones that are going to be the winners. TSMC's had to build a plant in Arizona, which is expensive, but it's part of the deal with the US. So I think you can't really escape that. But yeah, I think those hopefully for me would be the key winners. Okay, let me just go back to the question thread. Sorry, I'm going to try and answer these really quickly because we're running out of time. Okay, so what will be the impact on cryptocurrency with Trump 2.0? Your view on the risks and whether wise to add a small percentage in one's investment portfolio. Okay, so crypto is really, I think it's up to you and your own personal risk profile, right? We've seen BlackRock, Fidelity launch IBIT, and that iShares launch IBIT, and then Fidelity launched their own Bitcoin ETF as well. Obviously, Bitcoin's talking their own book, but they say that retail investors or insti investors, it's no harm having a 1% to 2% allocation to Bitcoin. I wouldn't disagree with that. I think you size your position correctly. You put it in if you do like it and you want to have it as a hedge. Again, it's very different to gold. It's not the same as gold. But if you want it in as a small position, then fine. But I don't agree with people putting in like 30, 40, 50, 60% of their portfolio into crypto. So that's just be sensible, I would say, on the risk and be aware of the risk and be aware that it could go to zero. I think that's the most important thing when you talk about crypto. But I think, Trump is we've seen it. He supports it. He likes it. He's a big fan of it. And I think that's going to be probably positive medium to long term for crypto. But I would say, it's really Bitcoin at this point. Okay, hopefully that answered that. Okay, I'm going to try and answer these two really quickly. Sorry, in a couple of minutes. Okay, so how will the potential shift to semi-annual reporting for publicly traded companies impact investor confidence and stock market volatility? Yeah, so I think this is another thing with public markets, right? There's always this obsession with next quarter's numbers, and will it be semi-annual reporting? I don't know if it will end up being like that, but I think in terms of impacting investor confidence, yeah, it probably will, right? You obviously want a more frequent look at the books and understanding what companies are doing. I don't think that's on the cards at this point in time. I mean, there is talk about it potentially happening, but on the whole, I think more transparency is better for investors. That's in short. That's how I view it. Okay, and then sorry, last one. Is market too high? Should investors put money in the US T-bills and wait for a drop? Again, this is all timing the market, which I don't like to do. Allocating your capital. The data show that if you invest at market highs, your 1 year, 3 year, and 5 year returns are actually not that different from investing at any other time, because there are so many market highs that keep getting set. Record highs get set. There's an average in the S&P 500 of like 16 a year over the past 20 years. So I wouldn't say this. I wouldn't attach too much importance to trying to time the market. I've always said, allocate what you need to allocate, be sensible, have an emergency fund, etc. But don't sit on too much cash if you don't need it. I'd say that's how I view it. That's how I view things. So sorry, I think I've kind of answered everything I've gone over. Hopefully I've answered all the questions, and I'll pass it back to you, Sean.
Hi, thanks, Tim. Okay, so we're going to be sharing a bit more about our exclusive promotions right now. And I think he had very keen sharings on terms of the FOMC that's coming up. So in terms of this, we have $250 worth of Takashimaya vouchers if you register your interest in an upcoming email. So you just need to place a deposit of at least $1,000 by 17 September and trade a notional volume of 500,000 US. So aside from that, we also are this is something that is only exclusive to Singapore users, and the deadline for the promotion is at the end of this month. So to wrap things up, if you would also really be kind to give us some feedback on this so that we can also improve in terms of our webinars, and also if you have any questions, you also can send it in to us through this QR code. So I'm just going to leave this slide open for 2 to 3 minutes, and you can just give some feedback. Thanks. Also, if you're still here, you can also join our next webinar, which is on our website. That will be upcoming. And I'll, of course, like to thank you for your time and appreciate the feedback as well. Thank you.
Thanks, everybody.